Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. How to make the most of your equity. One of the most powerful elements of property investing is that you can access the equity you have in your current property or properties to continue to invest and grow your portfolio. It can be a misconception that you need to have large or huge sums of money up front to grow a large portfolio, when in reality you can just wait for the natural growth that occurs over time and leverage the equity that has been created in your property portfolio. What is equity? Equity is the market value of your property less the money you have against it. So for example, if your property is worth $500,000 and you have a mortgage of $300,000 remaining on the property, then you have $200,000 in equity that you can access to continue to invest. Further on, if the value of your property grew further to $600,000, that would mean that you would have $300,000 in equity in which to invest and access. This highlights the power of capital growth when it comes to building a large portfolio. The first step in accessing equity you already have in your home is to get your property valued. It is important to get it valued by an independent valuer or a panel valuer for the lender who works with many types of lenders or many types of borrowers, and your mortgage broker will be able to guide you on the process, because it can be complicated and confusing, and also difficult to organize in some instances. Similarly, your broker will also be able to help you structure your loan in a way that will be most suitable for your situation. For example, you might want to cash out a portion of your equity and leave it in an offset account to use as a deposit on an investment property, and that's perfectly doable within the LVR limits as well. It's also worth noting that to access the equity in your home, you will still need to meet the normal requirements from the lenders when applying for a home loan. Mainly, this is in terms of servicing based off your current income and expenses. So when it comes to investing your equity, your mortgage broker will be able to work with the lender to determine not only how much equity you can access, but they will also be able to set a pre-approval limit for your next purchase. As a general rule, you only want to be borrowing up to 80% of the property's value in order to avoid other costs such as lender's mortgage insurance, which is LMI, or lender risk fees, LRF. And each lender and each insurer has a different method of calculating these additional fees above 80% LVR, loan to value ratio. So returning to that example that we just had of the $500,000 home with a $300,000 mortgage. So while you still have $200,000 in equity, it would be most likely that you'll be able to access $100,000 more, which is roughly 20% of the property's value. These funds can then be used to pay for the deposit on another property, as well as additional costs such as stamp duty, settlement, and other valuation expenses. So in total, with the $300,000 mortgage, plus the additional $100,000, that brings a total debt to $400,000, and that brings a total LVR to 80%. Over time, we know that property is an appreciating asset, and when your properties rise in value, you will be creating more and more equity that you can continue to access. This is how you can build up a large portfolio, and with only the one initial deposit on your first property. So it can be a strategic move. It just helps to know that what your options are when it comes to equity, what you currently own, what you currently have, and what you currently have owing. Your broker can conduct a full assessment on this and help you understand what your ability to access money is within your current properties. So another further conversation to have is, should you consider a cash out refinance? With many Australians still being impacted by the bug, the situation has forced everyone to examine their financial situation closely. If you're one of those who are looking at ways to free up some cash just for a just-in-case situation, then a cash-out refinance might be something to consider. A cash-out refinance can work by taking out another loan which is larger than your initial mortgage. This is usually a possibility when there has been some growth in the value of your property and you've been able to build up some additional equity and additional servicing power along the way as well. And generally speaking, homeowners are able to use the additional funds to put towards things such as purchasing an investment property, consolidating debt, or even keeping it in a savings account for perhaps a rainy day. However, there are also some other considerations that you need to take into account, because not all lenders are comfortable letting you cash out compared to how times were previously. So depending on the type of loan and lender, you might be required to indicate how you intend to use the funds that are going to be released. So this may be in the form of a statutory declaration, a purchase receipt, perhaps a signed contract, or even a detailed breakdown if you intend to use it for a business purpose. So speaking to a mortgage broker is crucial and is a great way to start this process, because you want to find out your options, you don't want to be wasting time, and ultimately you want to be maximizing or making the most use of your equity and your cash as well. So the advantages of cashing out include, there's a potential to lower your interest rate with a new loan. If you are, so for example, if you are, say, looking to do back to that $500,000 home with a $300,000 mortgage, perhaps you are on a, for example, 3.5% rate, just a random number. I'm not sure exactly what each lender has at that type of price range, but say 3.5%, and you're interested in doing a cash out for the extra $100,000 to bring it up to 80%. Maybe your current lender hasn't adjusted the rate since you first got it, or if they have, maybe they haven't passed on the full rate cut. By going to a new lender to refinance and do a cash out as well, you may be able to get that new introductory rate, or perhaps that new reduced special rate or discounted rate, which could be maybe below 3% or close to 2.5% if you're lucky. So it just, obviously that isn't referring to any lender in particular. It just depends on speaking to the mortgage broker and also finding out what your options are. So the second advantage, if you are carrying on a lot of high interest debt, potentially rolling it into a new mortgage could see you end up with lower repayments. And the third reason is that you can put the cash out funds to good use and look to make some improvements to your current home or investment property, potentially adding value above and beyond the cash out amount. So maybe putting in a pool, doing up the kitchen, doing some landscaping around the house. It just becomes an issue as well, the cash out, when you want to start doing major internal structural works. Obviously that can be an issue, but it's definitely within the realms of discussion. But mainly superficial work is what's preferred, I would say. So the disadvantages of cashing out include leveraging off your family home if you've run into financial trouble might not be a sound plan. And again, that's an option for the customer and perhaps their accountant or financial advisor or financial planner to discuss. Secondly, you can only borrow up to 80% of your property's value before being required to pay lender's mortgage insurance or lender risk fees. So obviously, if you're already borrowed up to 80%, then there isn't much room to be cashing out, I suppose, in a way that would prevent you from having to pay LMI. Thirdly, your repayments could be higher and you might end up paying more interest if you extend the length of your loan. With this notion of rolling over debt, this one could be perhaps you want to refinance, but you can only qualify for a low doc lender or a near prime lender because you've had a default, or perhaps your income and tax return portals aren't all up to date if you're self-employed, and you're on a nice prime full doc product. So if you do decide to change, you also need to understand that you're going through another full assessment as well. Obviously, it depends that if you want to do it as a low doc or not. Fourth, if you're looking to consolidate debt, the benefits of lower interest costs might be offset by a longer loan term. And lastly, there are costs associated with a cash out loan. These include application fees, legal fees, valuation fees, discharge fees, for example. So before considering any type of cash out or equity release when your home is at stake, it's important to closely consider what you intend to do with the funds. There are other options available to access equity, and even other types of loan products that might be more suited to your financial situation. The best place to start is to speak with a mortgage broker to let them help you assess your personal situation. And that concludes this episode of the Cost of Carry podcast. Thank you all for tuning in, and I'll see you in the next episode.